The cryptocurrency industry is facing its most challenging period since its inception, with numerous major players teetering on the edge of bankruptcy. Today, we'll dive deep into 15 cryptocurrency companies that are showing serious signs of financial distress and what this means for the broader crypto ecosystem. First on our list is Digital Currency Group, DCG, once valued at over $10 billion. The company's troubles began when its subsidiary Genesis filed for bankruptcy in early 2024. DCG's debt obligations have ballooned to nearly $2 billion, and they're struggling to meet payment deadlines. The company's other major subsidiary, Grayscale, has been hemorrhaging assets since the approval of spot Bitcoin ETFs, putting additional pressure on DCG's already strained finances. Next up is Binance, US, which has been grappling with regulatory challenges and a mass exodus of institutional clients. After former CEO Changpeng Zhao's legal troubles and subsequent resignation, the American arm of Binance has seen its trading volume plummet by 75%. The company has laid off 33% of its workforce and is struggling to maintain banking relationships, making it increasingly difficult to process fiat transactions. Third on our list is Huobi Global, now known as HTX. The exchange has been hit hard by China's continued crackdown on crypto trading. Their native token, HT, has lost over 80% of its value in the past year, and reports suggest they've lost access to crucial banking partners in Hong Kong. Internal documents leaked to the media indicate they may have less than 3 months of operating runway left. BitMEX, once the leading derivatives exchange, has fallen from grace. Their trading volume has dropped by 90% from its peak, and they're facing multiple class action lawsuits from traders who lost funds during the March 2024 market volatility event. The company has closed offices in several countries and is reportedly seeking emergency funding to stay afloat. Celsius Network, despite emerging from bankruptcy in 2023, is again showing signs of financial distress. The restructured company's attempt to pivot to Bitcoin mining has been unsuccessful, with mining operations running at a significant loss due to high electricity costs and aging equipment. Their new token, CEEL, has performed poorly, trading at just 10% of its initial offering price. Sixth on our list is Crypto.com, which has been burning through cash at an alarming rate. Their aggressive marketing campaigns, including the $700 million Staples Center naming rights deal, have left them with significant financial obligations. The company has terminated multiple sponsorship deals early and has been quietly selling off real estate assets to raise capital. BlockFi, which attempted to restart operations after its 2022 bankruptcy, is again facing serious financial difficulties. Their new lending model has failed to attract significant institutional interest, and they're struggling to compete with traditional finance companies that have entered the crypto lending space. Sources suggest they may file for bankruptcy protection again by the end of 2025. Nexo, despite maintaining a brave face, has been hit hard by regulatory actions in 8 different countries. Their assets under management have declined by 60% in the past year, and they've lost several key banking partnerships. Internal documents suggest they're operating with negative cash flow and may need to halt withdrawals soon. The 9th company on our list is Gate.io, which has seen its market share erode significantly. They've lost most of their institutional clients to larger exchanges, and their attempt to expand into the NFT market has resulted in substantial losses. The exchange has already suspended operations in several countries and is reportedly seeking a buyer. Bittrex Global, following the closure of its U.S. operations, has been unable to maintain profitability in its international markets. The exchange has lost most of its market makers, leading to poor liquidity and declining trading volumes. They've already begun selling off infrastructure assets and have reduced their workforce by 70%. OKX, while still maintaining significant trading volume, is showing concerning signs of financial stress. They've been hit hard by increased regulatory scrutiny in Hong Kong and Singapore, their key markets. The exchange has been forced to set aside large amounts of capital for potential regulatory fines, straining their operating budget. The 12th company facing potential bankruptcy is Gemini. The Winklevoss-led exchange has been unable to recover from the Genesis bankruptcy fallout and continues to face legal challenges from both regulators and customers. Their attempt to pivot to institutional services has failed to gain traction, and they've been forced to lay off 40% of their staff. BitGo, one of the largest crypto custodians, is struggling to maintain its market position as traditional financial institutions enter the custody space. They've lost several major clients to competitors like BNY Mellon and State Street, and their insurance costs have skyrocketed following several security incidents. Amber Group, once valued at $3 billion, has seen its fortunes reverse dramatically. The company's aggressive expansion into retail trading has backfired, resulting in substantial losses. They've already defaulted on several vendor payments and are reportedly seeking emergency funding to avoid immediate bankruptcy. Finally, Blockchain.com, one of the oldest companies in the crypto space, is showing serious signs of distress. Their lending business has accumulated significant bad debt, and their attempt to pivot to institutional services has been unsuccessful. The company has already closed offices in several countries and is reportedly exploring a sale of its retail wallet business. The potential collapse of these companies could have far-reaching implications for the crypto industry. Combined, they hold billions in customer assets and employ thousands of people. Their failure could trigger a domino effect, potentially leading to a broader market crisis. However, it's important to note that the crypto industry has shown remarkable resilience in the past. Previous collapses, like Mt. Gox and FTX, while initially devastating, ultimately led to stronger security measures and better risk management practices. The potential bankruptcy of these companies might serve as a necessary cleansing of the industry, removing over-leveraged and poorly managed entities. For investors and users of these platforms, the key is to remain vigilant. Diversifying across multiple platforms, maintaining proper security practices, and keeping detailed records of all transactions is crucial. It's also advisable to regularly withdraw funds to self-custody solutions rather than keeping large amounts on any single platform. The next few months will be crucial for these companies. Some might secure last-minute funding or undergo successful restructuring, while others will likely cease operations. This period of uncertainty and potential consolidation could mark a significant turning point for the cryptocurrency industry, potentially leading to a more mature and stable market structure. What's clear is that the era of easy money and unchecked growth in crypto is over. The survivors of this period will likely be those with sustainable business models, strong risk management practices, and a focus on regulatory compliance. The industry's future may look very different from its past, but that's not necessarily a bad thing for its long-term viability and adoption.